Hello everyone, welcome to STRIAS. So in this lecture, I'll be speaking about national income accounting. I'll be covering all the things about national income, GDP, GNP, NDP, NNP, what is factor cost, what is market price, what are product subsidies, what are product taxes, production subsidies, production taxes, and how we are measuring and how we have shifted from ASI to MCA-21. So why we have shifted. So these things and all will be looking in this video. So without taking late, let's dive into the subject. So national income accounting. So in UPSC, whatever it is, if you do a word breakdown, it will be very easy for you to solve the questions. So nation is nothing but, so there is in political theory of class 11, there is one mnemonic to remember what defines the nation. So nation has something called territory, government, population, and sovereignty. And there is one previous year question also about what is a nation. Fine. So nation is something which has a territory, nothing but a land. Maybe air space also we can consider. And also we can see about zones, international coastal zones also there, which you study in geography. It which belongs to territory, and also embassies. Indian embassy in US is also Indian territory. Fine. Then government, population should be there, and also sovereignty. The ability to take decision without any interference is called sovereignty. This is the definition for nation. Then income. Income is something which you earn, right? We know that we have four factors of production. So what are those? Land, labor, land, labor, capital, and entrepreneurship. So if you have any doubts regarding this, I have already uploaded a video about the microeconomics. So in that you can watch that. So land, for the land, what income you will be earning? Rent. For labor, wages or salary will be your income. For capital, interest. So capital is not money. Capital is something which give you guaranteed returns in future. Entrepreneurship, you'll be getting profit or loss. So if we calculate all these things, then it is called income. So why you are getting income? Because you are producing some goods and services. For example, if you provide land to some factory, you'll be getting a rent. If you are going to factory as a worker, you will be getting wages or salary. Or else if you are investing in that factory for buying some machines or for skilling the people, social capital. So for that you'll be getting some interest. It means that you'll be getting future stream of benefits. And entrepreneurship, if you use your brain and if you use your circle and if you can sell these products, you'll be getting profit or loss, which is called income. And when it comes to that, think about something like pension, which is given by government, and pocket money, which is given by your parents to you. Can we call it as income? No, we cannot call it, because we are not earning by providing the four factors of production, right? So these are mere transfer payments. So pension, pocket money, the government schemes money which you get from government without giving any of your four factors of production is called transfer payments. That. So now we can combine a word called national income. So national income is nothing but total market value of final goods and services produced in an economy in a given year. So recently government has changed, I mean, for making it easy, government has used the word tax years, right? So before we used to use financial year and accounting year. Now everything it is called tax year. Okay. So national income, what is the definition? Total market value of goods and services produced in an economy in a given year. That accounting. So what do you mean by accounting? The thing, you make some calculations about how you are spending and how you are producing or how you are doing an expenditure is called accounting. So for the nation, there should be some body to make some accounting. Fine. So in India, we have a body called NSSO. Okay, fine. Before getting into accounting, so we'll look at four factors of production, and also we'll look at something called circular flow of economy. So think that you are a household and there is one firm or factory or industry or a company, firm or a company or factory or industry. So you are providing something called factors of production to the company, four factors of production to the company: land, labor, capital, entrepreneurship. So company will be paying you something called income, right? Then with this income, you will be doing something called expenditure to buy the goods and services produced by the company. Okay, you are giving four factors of production. For example, you are working as a labor. So labor, the company will be paying wages or salary as a income to you. So with that income, you will be doing some expenditure to buy goods and services which are produced by the company. So this is called goods market, and this is called factor market. Fine, here you are doing labor or its land or capital. You are providing four factors of production to the company, and they are providing you wages or income or salary. And in the above, you are giving what you are providing them. You are providing them expenditure. You expenditure to them, and they are providing you goods and services. You are paying to them, and they are giving you goods and services, and it is called goods market. This is like very simple thing, but think about if government has come into the picture. If government has come into the picture, and what about if you start saving? So here, total income earned will be equal to total expenditure. Whatever you are earning, you are putting as an expenditure to buy goods and services. It will be equal to total value of goods and services produced, right? So produced, okay, produced. So your company is giving you wages, that is income. You are using the same income to buy the goods and services produced by the company. Everything is equal here. So it is in static equilibrium. It is in static equilibrium. Economy will be in static equilibrium. So total income earned, if you count it, it is called income method. Total expenditure, if you count it, it is called expenditure method. And if you find out the value of total value of goods and services produced, then it is called production method, right? So here there is no government intervention, and people are buying the goods and services only from the one company, and they are not doing any savings. At that time will be in static equilibrium, but economy won't be this much easy, this much simple. It will be little complex. So take a case one. some people started doing something called savings. Household started to save. Right? So they started to save. When they start saving, they got 100 rupees as a income or wage. They started saving 20 rupees and they started doing they will do expenditure of 80 rupees to buy goods and services produced by the firm. Okay, but this firm is producing 100 rupees worth goods, but the people are buying only for 80 rupees. There is a leakage of 20 rupees to the bank, right? There is a leakage of 20 rupees to the bank. So now what firm will do? Firm will produce only 80 rupees goods, and firm to bridge this gap, it will be increasing the price of the products. At that point of time, you will be spending more, right? So again, this is called state of dynamic equilibrium. It means that if you do savings also, this company will be getting a loan from the bank. It will be using to increase the technology. It will be making more good products, and it will be again selling to you at higher price. At that point of time, again you will be getting a loan from the bank, or you will be spending to the company. In this state is called dynamic equilibrium. But between this, there is something called leakage, that is nothing but savings. Fine. So between the period where the company develops and these people will be doing savings, at that point of time household income will decrease because company is producing less and selling less. So if company gets less money, it will be paying less to the household. That's why it is called leakage. Saving is called leakage. And one more thing, so take a case 2. So here what happens is, government comes into play and starts taxing the people, start taxing the people for their income. So now household is getting rupees 100, from that 20 rupees savings, 20 rupees as a tax to the government. So what is left? 60 rupees is left. So what happens to firm? Firm will produce less. Firm will produce less, and also firm will be giving less income to the household. That's why the government tax. So household can now buy only for 60 rupees. It is less. So it will impact firms. Firms will earn less. At the same point of time, firms will pay less to household. They will say that we don't have any income. So how we can pay to you? Right. Then third scenario is, households, they want some premium products. So they are buying it from abroad. It means that they are doing expenditure on the products from the abroad, and they are importing the products. So here the money is getting leaked to the foreign company. So Indian firms or domestic firms will get less income or less income. So domestic firms will pay less to the households. So in these three scenarios of savings, tax by government, and imports, what happens is, there is something called leakage. There is something called leakage. Fine. Then think about a scenario of case 4. If government gives subsidies, If government gives subsidies, what happens? People will buy more. Household will buy more from the firms. So firms will be paying more to the household. This means this subsidy given by the government is called injection. Right? Then what about exports? If a company is exporting more, so household is giving a labor to the firm and the firm is exporting more. It means that it is receiving money from the foreign, dollars from the foreign. It means that the firm will now pay more to the household. It means it is one of the injection. And what about the company take loan from the bank, take loan from the bank and invest in a new technology. It means they are getting some more machines to work. It means now firms will pay more to the households. So this also will be a injection. Right. So there are three injections and three leakages into the economy. So three injections are, first thing is investment by taking money from the bank, investment into the technology or investing to get a better social capital by training the people or labor who are there. Then investment, exports and government subsidies are the three injections. Then when it comes to three leakages, what are the three leakages? So the three leakages are savings, tax by government, right, and imports. So now we'll draw the circular flow of income with these complexes. Fine. So I'll be using different colors. I have that flexibility here. So I am a household and there is a company, right? So I'll be giving a factors of production to the company and the company will be giving me the income, right? So I'll be doing expenditure, which will be income to the company, and the company will be providing me with goods and services, right? And what I'll be doing is I'll be paying tax to the government. I'll be doing something called savings to the bank, and also I'll be getting imports, foreign company, foreign firm. From the foreign firm, I will be paying money to the foreign firm and I'll be getting something called imports. When it comes to firm side, so I'll be using different color for injections. Firm will be getting money from the bank as investment. So from the bank, firm will be getting investment. Then firm will be getting subsidies from the government. And also firm will be doing export to the foreign sector. Right. So this is the circular flow which we have included the injections and also the leakages. So it will be closer to real world, almost closer to the real world. So here you can take that in the economy, many firms or many companies and how the people, many households, and then you can calculate the national income with the help of this circular flow. So if there are no injections or leakages, if no injections or leakages, there will be static equilibrium. Fine. The first thing which we have seen, no exports, no imports. Whatever the thing they are getting, they are utilizing to purchase the goods and services which are sold by factories or firms. If injections are greater than leakages, if injections are greater than leakages, there will be upward equilibrium. I mean that if exports are greater than imports, it will be upward equilibrium. If leakages are greater than injections, then it is called as downward equilibrium. So whenever you see these words in a question, you should come to conclusion that upward equilibrium means injections are greater than leakages, exports are greater than imports. When you see the word downward equilibrium in budget survey, economic survey or budget, you can come to conclusion that leakages are greater than injections. If there is downward equilibrium, it means that imports are greater than exports. Fine. So we'll come to the last word of the thing which we are discussing. Accounting is nothing but measuring, right? So how to measure the national income? So we have seen that if you measure the incomes which are given for factors of production, then it is called income method. And if you measure the expenditure done by the households to buy goods and services, it is called expenditure method. Okay. So in income method, it is a measure of incomes of all households in the economy. Income of all households in the economy. So how do the incomes, how do households get income? In the form of wages or salary, or in the form of rent for the land they have, for the interest for the capital they put, and profit or loss for their brain, I mean entrepreneurship. So we can write that national income through income method can be written as wages plus interest plus profits plus rents. Yes. So expenditure. Here we have seen only expenditure of households in the circular flow economy, but expenditure will be done by, so C is nothing but consumption by households. Fine. Then I is nothing but investment by firms. G is nothing but government spendings on subsidies, on giving free of charge goods, on providing welfare schemes, on infrastructure. X minus is nothing but net imports or net exports. Fine, we'll be importing something and we also will be exporting something. If you differentiate that, then it is called net imports or net exports. Fine. So that so all of these things, C plus I plus G plus X minus M in the expenditure method, C plus I plus G can have foreign component, right? Indian government can import a metro train from Japan. Yes, I can get a air cooler from US to my home, and companies can get some new technologies to their company from foreign, from US or Japan or Saudi or anything. So here everything will be having a foreign component called CF. That thing we have to remove, right? We are speaking about national income. Yes. So C minus CF plus G minus GF, I mean foreign component, plus I minus IF plus, I will write export minus import as X. Fine. Then CF plus GF plus IF equal to total imports, right? That is nothing but M, which I have written. Fine. So total imports. Here total expenditure will be equal to, so I'm writing as M, C plus I plus G plus X minus M. Fine. Then households can spend on what? Consumption. That is nothing but C. Similarly, household should pay something called income taxes. Similarly, households will be having a future plans called savings. So CTS. So C plus S plus K, this can be written as C plus I plus G plus X minus M. Fine. So here S minus M, getting I from there to there. So S minus I equal to X minus M plus G minus T. So here we can see the relation between savings and investment. If savings are more, investments are related. Okay. It doesn't mean that see, if savings are more, the investments will be more. They are inherently related. They might ask, what all the things are inherently related? Savings and investments are more inherently related. Right? That investment investment has two factors to influence. Two factors will be influencing the investment. One is cost of investment. For example, if I have to open the water mineral plant in my village, I'll be checking whether if I put an investment here, how much return I'll be getting, and is it feasible? Then return of investment. For example, a cost of investment is nothing but if I put for 5 lakhs, can I get it a return for 1 year? If I invest somewhere else, how much cost I will get? Then do I get returns? Fine. So investments are dependent upon two things: cost of investment and return on investment. CR, ICR. Fine. So cost of investment is nothing but price of borrowing money. For example, if I don't want to invest 5 lakhs on water mineral plant, I will give for interest if the interest rates are high. Yes. So price of borrowing money is nothing but interest rate. So these interest rate depend upon demand of money. If all the people are having money, if the money supply is more in the market, so there will be demand of money or not? No, there won't be demand of money. If demand of money is high, if the season is like marriage season, if they want to do the marriages, they have demand of money because they have to do it in a grand way, this society and all. Yes. Then supply of money. Fine. So on these things, it will be dependence. Then we'll go for next method called production method. Production method is nothing but value of output, value of goods and services, or output produced in an economy. If you count down how many goods and services are produced in an economy, then it is called production method. Fine. So it will be a total output. So there are two types of goods. One is final good, another one is intermediate good. So in this final goods, intermediate goods are assistance in production. Fine. And we only will be calculating the final goods while calculating the GDP. While calculating the GDP, this should be remembered. Why? We'll be knowing the reason now. So GDP is nothing but gross domestic product. It means that any product that should be produced domestically. Fine. So it is nothing but value of final goods and services. Final goods and services that are that are produced in an economy in a given time period. Fine. So value is nothing but only the things which can be valued. For example, we gonna speak about care economy, in which our mothers care for us and they'll be taking care of home, but it is not valued. They are not paid, right? So we'll be calculating the things only which can be valued. Fine. And final goods. Here, intermediate goods are ignored, spare parts, and the goods which are used as assistance in the production are ignored because it will lead to double counting. Fine. So, and we also speaking about produced. We are just producing. Sale doesn't matter. If it gets sale or not, it doesn't matter. If you are producing in a particular year, then it will be counted as GDP. Okay. Then sales do not matter. Only the production matters. So we are speaking about domestic. It is nothing but it should be produced in our territory, in our Indian territory. If it is produced in Indian territory, then it is called GDP of India. Okay. So this territory can be geographical territory, embassies, exclusive economic zone in coastal areas, right? And who produces doesn't matter. For example, Kia companies producing cars nearby my village. So it doesn't matter whether it is a Japan company or South Korean company, they are producing in our territory, so it will be counted in our GDP. Okay, who is producing and who is producing doesn't matter. If they are producing in our territory, then it comes under our GDP, and it will be in a time period, mean time period. Fine. Then we have something called GNP. It is nothing but gross national product. So we'll decode this term gross. Gross is nothing but net minus depreciation. For example, if you bought a car and you are running a travels, so for the first year you won't be getting any you won't be getting any damages, or you won't be getting any mechanic things to be done. You won't take car to the garage in first few months or 1 year. But year after year you need to make some changes, or you need to change some parts of the car. So that is nothing but depreciation. So gross is nothing but net minus depreciation. National, it is nothing but, previously in GDP I told that if anyone produces also it will be fine. But here we will be counting what our nationals, what our citizens are producing. Fine. And the product is the same. Okay. So nationals are nothing but citizens of the country, irrespective of their location. Irrespective of their location. If my friend is in US and if he is producing something there, if he is producing some goods or services there, if he is working as a software engineer, it can be considered as a service. Then his service also can be considered as gross national product. Fine. Then so GNP can be written as total value of final goods and services. Final goods and services produced by Indians in a given period of time. Usually we'll be speaking about year, tax year. Indians in India plus Indians in foreign. Right? So GDP is output of total value of goods and services is nothing but output of Indians in India plus foreigners in India. Right? We don't say who is producing. We'll see just they are producing in India or not. Fine. But GNP is nothing but something output of Indians in India plus Indians in foreign country. Right. So we can see it like this. GNP is output of, so one second, if we'll write it without any complexity. So minus GDP minus foreigners output in India, GDP minus foreigners output in India equal to GNP minus Indian output abroad. This we can write, right? GDP minus, so one more time for the clarity. GDP equal to outputs of Indians in India and output of foreigners in India. GNP equal to output of Indians in India plus Indians in foreign country. So this can be written as GDP minus foreigners output in India equal to GNP minus Indian output abroad. Right? So yeah, GDP minus I'm doing this. I mean, I'm doing minus of GDP's component in GNP. It will be equal to GDP minus GNP component. Fine. So here GNP equal to GDP plus Indians output abroad minus foreign output in foreigners output in India. Okay. So this can be written as GNP equal to GDP plus, this whole thing can be written as net factor income from abroad. I'm writing a plus here to Indians output abroad because most of the Indians will be there in the foreign. We can see that many of them have migrated out of our nation in the previous years. That's why I'm thinking that what Indians are producing in the foreign countries more than what foreigners are producing in the India. That's why I'm doing a minus, and this can be written as net factor income from abroad. Yes. So abroad or foreign is nothing, is same. So here net factor income from abroad. So GNP is nothing but, so if someone asks what is the relationship between GNP and GDP, so GNP equal to GDP plus net factor income from abroad. If you didn't get it, just go through the video one more time from GNP part and you will get it. Fine. Net factor of income from abroad can be positive or negative. So I told that many of the Indians are there and many of them, I am assuming that, are there in abroad and they are producing more than what foreigners are producing in India. That's why I'm telling that our NFIA is positive. Fine. Then, so nowadays we calculate gross national income, not GNP. Okay. Nowadays we are calculating only gross national income, not GNP. Value is the same. Value is same. Just we are naming it as gross national income, and GNI is easier to measure. Fine. Then value addition method. So we have seen three methods: income method, output method, or and expenditure method. Output method or production method are same. And now we'll be seeing value addition method to count GDP. For example, if I'm producing something, if I want to produce a car, I need iron ore. Then iron ore needs to be polished and it should become a sheet. Then for the sheet, I should make some shape, and I should do some, I mean, do some engineering, and I should get into a car. Here, I will be buying iron ore from the company. They'll be selling it to me. If they are getting it for rupees 100, I mean, to get the iron ore of 100 kgs from the from those sites, from mining sites, they'll if they are getting for rupees 100, they will be selling it for me for 200 rupees because they have worked on it. That is nothing but value addition. Then I will get it from then this will be brought by some of the companies, some of the factories. They'll be turning the iron ore into a iron sheet or aluminum sheet or steel sheet. So they'll be selling it to me for rupees 500. So after getting this iron sheet and making the car, I'll be selling it for rupees 1000. So just take it as an example. Here we can see that in every process the value is added, right? So if I have to measure how much or what is produced, if I measure all these values, then I will be getting into the conclusion that okay, this much will be the price of the product and this is the production that have been done, right? So producers produces a good, it is intermediate or final, it depends upon the buyer. I may take car and I may use it for I use it for Bharat to take the bride and bridegroom who get newly married. Then that will be a new business. That is not an intermediate final good. That will be intermediate good again. Then producer cannot know if it is a final good or intermediate good. That's why we'll be calculating the value addition. So instead of trying to get whether it is intermediate good or final good, we can check how much value added at each stage. How much value added at each stage, right? So why I'm introducing this method is we have to calculate only final goods. Intermediate goods are not allowed because there will be double counting. So those who produces, they don't know that people who buy from them will be using it for next production process, or else it will be a final consumption. Fine. So here, for that, if they won't be knowing this, right? So rather than knowing whether it is intermediate or final good, we can see how much value added at each stage. So summation of value added at each stage equal to value of final goods or service. Yes. So what will be the what will be the price of the car? 200 plus 500 plus 1000. It will be 1700 plus taxes. So here, if I have added this value addition, I'm getting the final price of the car. So value added at each stage summation will be equal to the final value of goods produced, goods or services produced. Fine. So with this method, no need to differentiate about intermediate goods and final goods. So value added by producer equal to value added by producer will be equal to value of output minus value of input. Yes. So here GDP through value addition method can be written as summation of value addition of goods and services by all producers. Fine. Then in the previous video I told that total revenue equal to price into quantity. So this is a new concept. So total revenue equal to TR equal to PQ. Quantity is fine. We'll know how many cars. But what price? Is it the price which we get at factory gate? Is it the price which we get at wholesale market? Is it the price which we get after getting taxed by the price plus tax? So we need to find out, right? So and also price also varies based upon time, and it also will be varying according to the different prices in the production. I mean, in the factory gate, it will be very less. When it comes out to the wholesale market, they'll be adding more price. If it is brought at showrooms, it will be brought with high taxes. Yes. So different prices in the production process, according to the different prices in the production process, will be having different, and based upon time also, price will be changing. So when it comes to Y means GDP, wherever I write Y, it will be a GDP. So Y GDP equal to total quantity of goods produced in 2024 into price in 2024. So this is the current market price. Yes, in price in 2024 is the current market price, and this whole Y 2024 is the nominal GDP. Why? Because I'm seeing it from the lens of the price which is there now in this year. If this GDP equal to quantity 1 car, but I am taking the price of the previous year. It is the last year price and I am comparing it. How much is the GDP? This GDP will be called as real GDP. Why? Because the price changes with the change in time. So if I have to compare GDP of different years, if I compare GDP of different years, then I have to take one stable year, right? I cannot take 2020 as for the comparison. how much price have been increased, because at that year, in that year we have COVID, right? So we have to take one stable year and we have to compare it with that year in which there are no much changes in the economy, or else there is very stability in the economy. So here the stable year is 2016 for to count the GDP. I mean base year for GDP. Fine. So nominal GDP is nothing but if you are checking the GDP price level in the same year, price level of the same year. It is nothing but current year. So it can be called as current price. Whenever they say GDP at current prices, come to the conclusion that it is a nominal GDP. Current year, they are looking at GDP, what is the value, then it is called nominal GDP. When it comes to real GDP, you will be comparing it with the base year. So at last year price level or base year price level, then it is called constant price. Why constant? Because it was stable price or constant price. So whenever they say GDP at constant price, then come into conclusion that they are speaking about real GDP. So there will be difference, right? Nominal GDP by real GDP is nothing but GDP at current prices by constant prices. There will be increase or decrease. Yes. So here we can write that this will be equal to inflation. This will be equal to inflation. And this concept can be called as GDP deflator, right? We are deflating the GDP with the help of the previous year prices or base year prices. And this GDP deflator will be measure of inflation. For example, your father or mother will be telling that last year dal was 1 kg of dal was 150 rupees, but this year 200. So if you are seeing the 200, the price of the dal, then it is current year price. It is nothing but nominal GDP at current prices. But when you see the same price of dal, when the production is good and there is no famine and uh, the year was very stable without any fluctuations, if you compare it with 2022, okay, so then it is called nominal GDP. If you want to bring out the changes, if it was 100 in the 2022 and now it is 200, if you have to bring out the changes, I mean bring out how much change has been, calculate how much change has been done, then you can calculate by 200 by 100, it is nothing but 2%. I mean 2 times it has changed. This is called inflation, and the concept is called GDP deflator. Okay, we can expect one question from GDP deflators. Why? Because our government is trying to change the base year from 2016 to 2024. Why they are changing also, we'll be speaking about that. Then we'll be speaking about base year. So base year, I told that a normal or stable year in which there is no war, no famine, no supply shocks, no droughts, no floods. Okay, then prices should not be volatile, prices should be fixed. Then production basket is nearly same. For example, if I compare 2024 with 2000, it will be very difficult to compare, because in my basket in 2000 I'll be having a keypad mobile phone, but in 2024 I'll be having a Android phone or iPhone. So basket will be different. So production basket must be same. The people who are in 2000, their needs are different from the people who are in 2024. So the production basket will be changing. So production basket is nothing but goods which we need in 2024. Okay, goods which we need now to supply, or else which more people are utilizing. For example, it will be different for rural, it will be different for urban, it will be different for agricultural laborers, it will be different for industrial workers. So we also will be seeing that in unemployment or poverty topic, how they will be measuring unemployment or poverty. We will be seeing that if it is recent production basket, it will be fine, and no structural changes in the economy. For example, demonetization, GST introduction, then COVID, these structural changes should not be there, then that year is called base year. Fine. Then we are speaking about the price will change according to the production process or production levels. Okay. So consumers, being a consumer, so I'll be using different color here because consumer, I'll pay market price. Yes. Then being a producer, I receive factor cost. Consumer will be paying market price. It is nothing but factor cost plus taxes. Yes. If I am buying a car, I should pay the how much producer's cost is. I mean rupees 17,000 in the above, 1700 in the above example, plus government will be taxing me because I am using the car. That environment tax, road tax, and then all the taxes they'll putting upon me. So that is tax, right? So producer will be receiving the factor cost and consumer will be paying the market price. So money utilized by producers, nothing but factor costs. They have to give wages, interest, profit, rent. Yes. So these are the factors of cost of production. So factor cost plus taxes minus subsidies will be equal to market price. For me, if car is 1700, I'll be selling it for 1750. 1700 plus tax 50 rupees. No subsidy because car is making pollution. So I'll be selling it for the market price of rupees 1750. This 50 will be given to the government and 1750 will be paid by consumer. And factor cost is the total cost which happened to the producer to pay factors of production. So whenever I speak of GDP, GDP at market price equal to GDP at factor cost plus taxes minus subsidies. Minus subsidies. Here taxes are nothing but indirect taxes, nothing but GST. For example, GST will be there 18%. Fine. So factor cost minus subsidies plus taxes equal to market price. But this is not the true factor cost. While I am setting up the company, so think that I am producing EV cars. I'm getting a land. So land cost was like 1 crore rupees. But what happened is, if as if I am producing the EV cars, government has given me subsidy. As if I am doing the production of EV cars, government is giving the subsidy called production subsidy. And they also said that you are getting steel, so you have to pay tax called production taxes. Nothing but for land registration, for land registration, I will be paying some tax called production tax. Yes. So here, I have some basic prices to start a company minus production taxes because I have to pay that plus production subsidies which is given by government will be equal to factor cost. Yes. So here to buy a land, if I don't produce EV cars, then it will be very costly. If I tell to government that I'm producing the EV cars, they'll be giving me subsidy. Then when I go to registration, I need to pay some stamp duties and all. So that will be production taxes. Whatever I'm paying, I'm doing a minus, and whatever government is giving it me for free, that is called production subsidies. So basic price minus production tax plus production subsidy equal to factor cost. Then we can derive this in reverse way. So I told that factor cost plus production tax minus production subsidy will be equal to basic price plus product tax minus product subsidy equal to market price. Yes. Now previously I wrote that GDP MP equal to GDP factor cost plus product tax minus product subsidy. Now in the place of GDP FE, I'll be writing that GDP at basic price plus production tax minus production subsidy plus product tax minus product subsidy. So here GDP at market price will be equal to GDP at factor cost plus tax minus subsidy. What type of taxes will be including? Will be including product and production subsidy, also product and production subsidies. So whenever the standard notation, whenever you see a term GDP in newspaper, you should get in the conclusion that GDP is nothing but GDP at market price, which is nothing but GDP MP, this formula. Fine. Then whenever you see gross value added, you should come into the conclusion that gross value added basic price is nothing but gross value added plus production tax minus production subsidies. Then so GDP MP equal to GVA basic prices plus taxes minus subsidies. Fine. So product taxes minus here product tax and product subsidies. Then how to estimate GDP of India? Measuring this term which we should not use, will be estimating, because we cannot get everything perfect, right? So we'll be using the term estimation, accounting estimation. First thing you should do is you should do sampling, right? Then you should be having one body to collect all the things. So previously it was annual survey of India. So it used to have NSSO survey, and they used to use something called production method. So total output, how much the factories or firms are producing in the country, then they used to get those data. But it is before ASI, annual survey of India, was before 2015. So in 2015 we have introduced something called MCA database, MCA-21 database, and here we are using something called value addition method or value added method, which we have seen. And it was base year for that was 2011 to 12. And this MCA database is Systems of National Accounting Compliant. Systems of National Account is given by UN, right? So who will be implementing this or who will be estimating this in India is Ministry of Statistics and Implementation. They'll be having a body called National Statistics Office, National Statistics Commission, and also a program implementation week called MPLATS. Here we have nothing to do with MPLATS, so keep it aside. So just remember that it will be having one office, it will be having one commission, and it will be having one separate program implementation wing under working under MOSPI, nothing but Ministry of Statistics and Program Implementation. So NSO will be having, used to have two offices called National Sample Survey Office and Central Statistic Office. Okay, so now they are commonly called as NSO before, but the work they will be doing is NSSO will be correcting the data. National Statistics Survey Office will be correcting the data, and CSO will be presenting the data. It will be presenting data in useful form, like statistics or bar graphs or this much. So why they will be correcting is they have to implement something called welfare schemes, or else they have to know how much production is happening, how much to what poverty level people are, how much money flow is there. These things are all we need to know, right? So for that they'll be doing some calculations. So it is done by NSO, National Statistics Office, which work under MOSPI, Ministry of Statistics and Program Implementation. Then National Statistics Commission is an advisory body. They'll be telling that people going for census, census record, officers going for census recording. So they'll be telling that which questions need to be asked and what type of questions need to be asked and how they should implement or how they should collect the data and what will be the sample. We can't collect the data of 140 crore Indians. We need to take some samples from rural area, from urban area, from agriculture sector, from industrial workers, these things. So this will be done by MOSPI in India. Then before 2015, I told that we used to have something called Annual Survey of India, and they used to use something called production method. So in this Annual Survey of India, they used to take only 20,000 firms, 20,000 companies as a sample, and they used to get data from them. They used to tell that please give us data so that we can calculate. Okay, so here 20,000 firms are there. In that, industrial manufacturing industries was given more priority. But in India, we have more service sector today, and we have agriculture companies also or firms also. So here it was manufacturing industry based, and various ministry were involved, and they need to compile data and they should produce this data. And it was very tough to extrapolate to GDP. And the base year they used to use was 2004, 2005. At that point of time, there were only keypad mobiles. Now we are having a Android mobile. So we need to shift, right? So after 2015, after 2015, what happened is we have changed it from sample from Annual Survey of India, in which 20,000 firms were there. Now we have changed it to MCA-21 database, Ministry of Corporate Affairs database, in which all the firms should register formally. All the firms should register formally, and it is not a survey, it is actual data. They should give us a balance sheet, how much revenue they are getting and how much they are spending. And this is not a survey, they should give us data. Then how much value added in each process of production should be recorded, will be calculated. For example, iron ore company will be giving balance sheet. Then we'll be getting balance sheet of Tata Steel and Iron Company. Then we'll be checking. So they have sold to them. So here this much value added, this much value added. So we'll be using this value addition and we'll be getting the GDP. Yes. And here number of companies or number of firms have been increased to 15 lakh firms of all the sectors. Here we used to give priority for manufacturing sector, but here all the sectors we have given a priority, right? Then so MCA-21 is more diverse and more representative sample, and it is not a survey. They should give the actual data. The base year for MCA-21 was 2011 to 21. Before it was 2004 to 2005, and it was very ancient, right? So we'll be seeing headline growth, and we'll be seeing core growth. I mean core inflation, headline inflation, they'll be speaking. So headline growth is nothing but GDP at market price. That is nothing but GDP at constant prices. It was earlier they used to calculate GDP at factor cost, but now we are using something called value addition method. So we'll be calculating the GDP at market prices and constant prices, not current prices. Okay. Then sector wise estimates. Before they used to use gross value added at factor cost, but now we'll be using gross value added at basic prices. That's why I have taught what is factor cost, what is market price, what is basic price. Fine. Then now, so coverage of financial sector also will be there. SEBI, PFRDA, IRDA will be there. Then local bodies and local bodies are also covered, and autonomous institutions also covered under this MCA-21 database. Then I told you that we are compliant with SNA-21. Why we are calculating this GDP? This GDP we are calculating it because we have to compare it with other nations, and we have to know where we are in the world. So for that we need to follow the method which they are following, or else we need to get into one standard method, and all the countries will be using that standard method, and we will be getting into conclusion that we are in this place of the world. If you are using one method and Pakistan using another method, South Africa using another method, then how we will be getting to know where we are, how much we are producing. All right. So here SNA-21 is Systems of National Accounting 21. I mean not 21. Sorry, SNA-20. SNA is the uh, method given by IMF and UN. Right. So it is for international comparison. First, they have given in 1998 how to use that. Then most recent one was 2008. They have given the revise they have revised the procedure, and in 2025 they're gonna give the new procedure. That's why this year there is more chance of asking about SNA and MCA-21, and they'll be asking about what is ASI and GDP factor cost. They used to use. Why now we have shifted to GDP at market price, the two constant prices, not current prices, right? So you have to uh, just practice. If you practice, then you can get it very easily. Fine. So I'll be stopping here, and tomorrow I'll be coming up with some more concepts of GDP, and also uh, I'll be completing what is NDP, NNP. So we'll see NDP, NNP here now itself. So NDP is nothing but net domestic product. It is nothing but NDP equal to GDP at market price minus depreciation. So net is nothing but gross minus depreciation. Fine. Then we have something called NNP. It is nothing but net national product. Net equal to gross minus depreciation. So NNP equal to GNP at market price minus depreciation. This NNP, GNP can be written as GDP at market price plus net factor of income from abroad minus depreciation. Right? GNP can be written as GDP plus net factor income from abroad. This we have seen. Then national income. It can be written as NNP at factor cost. National income can be written as NNP at factor cost. This you should remember. So NNP at market price minus indirect tax plus indirect subsidies can be written as national income. Fine. So tomorrow we'll be revising all these things, and I'll be back with new content. Hope you are liking this content, and if you have got benefited from this, please do like, share, and subscribe. Please do revise, and please try to make it on a paper and try to write without seeing, so that you can get it. Fine. So we'll be back. Thank you.